RIN TV coverage of the 2015 NARRA conference is brought to you by the National Risk Retention Association. Since the passage of the Liability Risk Retention Act, RRGs have enabled employers to band together to form group captives to better manage risk. Jon Harkavy was involved in the passage of LRRA in 1986 and now serves on the board of directors of NARRA. We got his thoughts on how the industry and regulators have evolved on RRGs over the years in his interview from the NARRA annual conference in Chicago. He has an interesting take.
The 1986 Risk Retention Act were actually amendments to the 1981 Act. The reason why they were needed was the 81 Act was limited to product liability, while in 1986 there was a general liability insurance crisis. And to meet this crisis, Congress decided that they wanted no part of any federal regulation, nor was there any interest on the part of any general tort reform, so that the Risk Retention Act presented an ideal vehicle for what the framework was, lead state regulation. You get licensed in one state, and with limited preemptions one can operate on the basis of a single state license in all 50 states. I believe the Liability Risk Retention Act has been a successful vehicle to provide liability coverages to policyholders. I believe that since then, more state regulators, basically through interaction, have become more comfortable, or at least understanding, of the preemptions from multi-state regulation, particularly form and rate filings and licensing, afforded by the Liability Risk Retention Act, and that they needed to respect them. There have been a couple problems, basically with the proliferation of fees and some overreaching by a number of states, particularly on registration. Registration in the Liability Risk Retention Act should be automatic upon filing of certain information, so that it's been more problematic. But in general, the lead state regulatory framework has been respected by different state regulators. The reaction of the NAIC has not been to the Liability Risk Retention Act. I won't say it's been warmly received, but they respected the approach because it really didn't involve direct federal regulation. It involved lead state regulation by a state regulator. However, with that said, there is still a mentality of most states that they prefer to have complete control of those entities operating in those states, and many regulators are not comfortable with the preemptions afforded by the Risk Retention Act, and some have perhaps overextended what they can do through the registration process and perhaps the imposition of fees. However, I believe that the greatest concern for the future of the industry lies in the NAIC, in that Congress, or the GAO, General Accounting Office, has more or less delegated proper standards for risk retention groups to the NAIC. And the NAIC has a very powerful tool called the accreditation process, by which they can refuse to accept the examinations of other states if they're not accredited. And through use of that accreditation process, unfortunately, the NAIC has shown a tendency to extend traditional regulation to risk retention groups, which would otherwise be preempted by the Federal Liability Risk Retention Act. So I would like to see a better relationship, and that would naturally take place between, in my opinion, the National Risk Retention Association and the NAIC, although I believe that there are certain limitations, basically because the states, to some extent, may not choose to follow the NAIC's lead, or the NAIC, despite their willingness to cooperate, has evinced a general proclivity to regard risk retention groups as they would surplus lines carriers. They are to be tolerated when the market is bad, but they would prefer not to have them in their jurisdiction when there's no availability crisis.
For more coverage of the 2015 NARRA conference, visit the RIN TV On Demand Library.